CDB, being among the top 5 non-bank financial institutions, is at the forefront of making luxury available to the consumer through technological innovation. CDB continues to keep technological innovation as a top priority, with the promise of many more technologically enabled products to come to empower the nation. CDB, your friend.
Hi, dear sir and my dear colleagues. We are here to present our group assignment that is under managerial finance. We are here to present financial analysis and interpretation of citizen development business finance PLC. So our outline includes it shows an analytical framework. Will give you an industry overview, horizontal analysis, vertical analysis and ratio analysis, and a conclusion throughout this presentation. So if you take the analytical framework, as I mentioned earlier, our main company will be CDB, that is a licensed finance company in industry. So the Citizen Development Bank Business Finance PLC will be the main company for the analysis, and our competitors will be or the other three companies will be Arpico Finance, Mercantile Investment and Asian Alliance. If you take a history or overview about the company CDB, it became a public listed company in 1995. CDB is licensed by Monetary Board of Central Bank of Sri Lanka under the Act number 42 of 2011. So if you take the network of CDB, it has about 71 online connected outlets. So it's a 75 billion LKR business. So its services includes fixed deposits and savings accounts, leasing, personal loans, home loans, pawning, corporate related credit and debit card facilities, foreign currency exchange, and other corporate financial services. Throughout the history of finance, history of CDB, they have won many awards actually recently. It's always been in the top 5 in 41 non-banking financial institutes in Sri Lanka. So 01 Award, Gold and National Business Excellence Award are key recently highlighting awards that received by CDB. So I invite my colleague to continue this presentation and present you the horizontal analysis. Thank you.
Hi, I am Chanaka. Now I am discuss about the tool used for financial analysis, which are horizontal analysis and vertical analysis. Actually, these analyses are carried out for get more information or intelligent information of available data in financial statement. When we move into the horizontal analysis, it is also called trend analysis. We choose 4 financial institutes for comparison, and the horizontal dimensions which we are using this presentation is a 5 years time. That means from year 2014 to 2018. Here we are checking what happened to the available data over a selected period of time and determine the increase or decrease taken place. And also same as analyzing has been simplified with charts and data which explicated different trends within the company and the industries. Then when we move into the vertical analysis, it is also called common size analysis. This is very much essential to compare different sizes of companies. For example, in this presentation we are using CDB as our main company, and we compare CDB with other 3 competitors. So it is very much easy to compare these companies irrespective of their size. So within the financial year. So each company's categories in the P&L as well as the balance sheet convert into the percentages, and then comparison is carried out. So that is the vertical analysis. So, tell you more about the ratio analysis, I would like to invite my colleague Rohini to continue from here onwards. Thank you.
Hello, I'm Ruini from Group A10 and I'll be taking you through the profitability ratios. Starting with gross profit margin. Gross profit margin ratio tells investors the percentage of revenue that the business has managed to translate into gross profits. CDB has had a slowly declining gross profit margin ratio since 2015. Similarly, its competitors like Alliance Finance and Apico Finance have also been seeing a reducing gross profit margin ratio over the same time, though some have slightly recovered in 2018. As of 2018, the gross profit margin ratios of Alliance and Mercantile Investments were both higher than that of CDB. One reason for the declining gross profit margin ratios is the regulatory and policy measures directed at imports in 2018, which negatively affected the vehicle market and thus affected the financial institutions like CDB, as vehicle leasing is a core lending product of such businesses. Gross profit margin and markup are two different sides of the same transaction. While gross profit margin shows gross profit as a percentage of the selling price, markup shows the gross profit as a percentage of the cost of sales. In the gross profit margin ratio, similarly, the gross profit markup of CDB has also seen a significant fall from 2015 onwards. Meanwhile, its competitors have also seen decreases in their gross profit markup ratios, but they have recovered in 2018. And they also have higher gross profit markups than that of CDB. Operating profit margin indicates the operating profit of a business as a percentage of its revenue. Operating profit margin of CDB has been relatively stable from 2016 onwards in the range of 16% to 17%. While Alliance Finance and Mercantile Investments faced reducing operating profit margins from 2015, they still maintained much higher operating profit margins than CDB. Net profit margin is arguably one of the most important profitability ratios that investors consider when deciding to invest in a company and determining their financial strength. Net profit margin is important because the increase in the top line revenue doesn't necessarily mean a company is making profits. The net profit margin of CDB has been relatively stable from 2015 onwards, though it has decreased slightly. Compared to its competitors, CDB has maintained a more stable and higher net profit margin, which would make it appear more reliable and attractive to investors. Therefore, despite lower gross profit margins and operating profit margins, CDB has proven that it has tight control of its expenses and protects the most important financial aspect of its business, which is the bottom line. CDB profit after tax in 2018 was 1.7 billion rupees, which was an increase of 22% over the previous year. CDB achieved this by increasing their asset base by 18% to reach 89 billion rupees in 2018. Another important ratio used by investors in assessing the profitability of a company is return on capital employed. ROCE measures how well a company is generating profits from its capital. CDB has steadily increased its ROCE from 2016, while its competitors have experienced deteriorating and fluctuating ratios. As of 2018, ROCE of CDB is also higher than its competitors. Return on equity is an important profitability measure for shareholders, as it measures how well a company uses its equity to generate profits. ROE of CDB has fluctuated between 16% to 20% over the last few years, while the fluctuation of ROE of its competitors has been more erratic. CDB shareholders' funds increased by 21% to reach 8.6 billion rupees in 2018.
As my colleague discussed, financial stability of a company can be tested in many ways. When it comes to liquidity ratios, liquidity basically defined as company to meet its short-term financial obligations when it's come to due in a short-term basis. There are three common liquidity ratios can be tested in financial analysis: current ratios, acid test, and cash flows. And when it comes to current ratio is the most liberal ratio in the ratio analysis. Current ratios identified company's ability to pay current liabilities from its current assets. This ratio one of the ratio that used to quickly measure the liquidity of a company. And so how we calculate current ratio? Current asset divided by current liabilities. So when it comes to our interpretation, CDB, we have a greater than 1% current ratio, which interprets that CDB maintains a healthy current ratio in the business perspective. So when it goes to others, Arpico Finance and the other mentioned companies, but they also maintain rather good current ratio when it compares to other companies. So these ratios, liquidity ratio is the most important in a business to find ratio interpretation. Thank you. Next part will be delivered by our next person.
I am Miranga from Group A10. I am referring to slide number 19 to 21, which shows asset management ratios. Asset management ratios means how productively firms using their assets. When we considering day sales outstanding ratio, it shows how long average debtors taken to settle their accounts. When we considering in 4 companies, 2016 to 2018, Alliance Finance shows the lesser value than the other 3 companies. Then I move to the fixed asset turnover ratio. Compared to the investment in fixed asset, how many times that the amount is earned in the form of turnover. When considering the period of 2014 to 2018, 2014 CDB shows the highest value, but the 2015 to 2017 Pico Finance taken the better place than the CDB. In 2018, CDB again shows the highest value among the other competitors. Then I move to the total asset turnover ratio. Compare the investment in total asset, how many times that the amount is earned in the form of turnover. When we describing more about the asset turnover ratios, high asset turnover ratios are desirable because it means company is using its assets efficiently to produce sales. That means the higher the turnover ratio, the more sales the company is generating from its assets. When considering the 2018 mercantile investment and the Apico Finance shows the better value than the CDP.
Thanks, Iranga. I'm going to talk about debt management ratios. Debt management is also known as gearing ratio, where the ratio that we can use to decide whether a company organization is highly geared or low geared. It's all about the long-term impact from debt and equities for an organization. So let's move on to the first ratio under this. It's debt equity ratio, where we are comparing debt over equity as a percentage. You can see in the left hand side CDB finance diagram. Last 4 years ended 2018, it's around 9.32. It's in 2018, and it shows as CDP Finance is an high geared organization, where it's having more than positive value, I mean value which is more than 1 as debt equity ratio. And when it comes to other organization that we are comparing with against CDP Finance, Alliance Finance, you can see that it's a drop in 2016 2017, where debt value is lower than the equity in 2016, which indicates that in 2016 Arpico Finance, Alliance Finance is low geared organization. And you can see 2017 in Arpico Finance there's a spike where debt equity ratio is very high, and which means very highly geared organization in 2017 Arpico Finance. And when we do the analysis, we figured out that Apico Finance have won 2 awards in 2017 due to their outstanding performance, so which reflect the same behavior here in 2017, which they have very high debt equity ratios. So let's move on to the next ratio. It's debt ratio. It's about the debts and liabilities that needs to be paid from the total assets of an organization. For the CDB finance, it's around 90, and for other organizations which we have considered here, also around 80, 70, except the Alliance Finance. Alliance Finance has around, the figure is around 50, 40, where they have some amount of money for as an equity uh, once they pay their liabilities, non-current liabilities. But when it comes to CDB finance, it's 90 is average. They have only 10% remaining once they pay the non-current liabilities from the total assets. So that concludes debt management ratio. I will like to hand over to Fasal to continue from here.
Thank you, Roshan, for a brief explanation on debt ratios. I'm Fazal here to discuss on market ratios. Market ratios are used by investors to evaluate a share of a company and to take decisions whether to invest or not. When we consider market ratios, we should understand the difference between earnings and dividends. Earnings are the profit which a company has made throughout that year, but a company will not pay their total earnings to the shareholders. The amount declared or transferred to a shareholder is being considered as the dividend. See, a basic evaluation for an investor is dividend per share. This is the ultimate benefit a shareholder can get through their investment. When you see dividend per share, CDB has paid 3 rupees and 50 cents in 2014 but increased to 5 rupees in 2018. Same way, comparably, Alliance Finance has paid 23 to 29 rupees 2014 and 15, but they have a drastical drop for 1 rupees till 2018. This is due to a reason of increment in shares from 2.4 million to 33 million due to a right issue. Second ratio is the dividend yield. As I mentioned earlier, the dividend per share divided by the price replicate in percentage is shown here. The same trend which was mentioned or shown earlier has replicated in this due to its show in percentages. An investor can understand the benefit which he would get due to his investment in percentages. The third one is the dividend cover. That is a capability of a company which a company can pay their shareholders is replicated in multiplications. So you can see Mercantile Finance, they have small number of 3006 shares and their capability to pay their shareholders is high. Companies having more shares, the capability will be shown in smaller amounts because due to their high number of shares. The second set of ratios is earning ratios. Earning per share is replicated on performance of a company. Earning per share, which is mentioned over here, if you see Mercantile Investments, their earnings is 210 rupees. But other companies, their earnings are less. This is because total number of profit after tax divided by ordinary shares will be derived the earning per share. Earning per yield also the same trend is being shown in percentages. So if you see earning per yield, that also replicates a performance of the company, how they can perform. Other ratio is dividend payout ratio. This is earnings divided by dividend is replicated over here. If you see CDB Finance from 2017 to 2018, they have a small drop, but other companies they have up and down performance due to their company performance. Through this ratio also we can understand the performance of a company. And profit earning ratio, a company's dividend or earnings divided by stock price is replicated over here. If you see CDB has a drop throughout the years. And the last ratio is market to book value. A company has a stock market price for that company, but net asset will replicate a book value. The difference between these two ratios have been replicated over here. So throughout these ratios, we could understand how a company is performing and whether to invest or not. The decisions can be taken through with this ratio understanding. Thank you very much. I will pass out my to my colleague Lahiru to explain you about the non-financial aspects of these companies which we have evaluated.
Hi, I'm Lahiru and I'm going to talk about non-financial analysis of CDB. For that, we took three main points, that is human, social and environment. When it comes to human, CDB, they have 1,600 employee base and they creating the value for those 1,600 employees in five main ways. Those are equity and diversity, talent acquisition, progressive learning opportunities, aspiration, humanity and relationship. So when it comes to equity and diversity, 35% of their employees are female, 49 outside the Western province, and also 47% are permanent staff. When we talk about the talent acquisition, they're giving opportunities to Sri Lanka graduate to join them as management trainee and also the internship opportunities. Also, they're doing some course reimbursement of their employees. And then we move to progressive learning opportunities. They have some virtual learning platforms for their employees and sales orientation programs in every week. When we talk about aspiration, they have monthly and annually performance management systems and rewarding systems, and also they have good employee successful plan, as you can see in chart. Then we come to humanity and relationship. They have some medical schemes like Suva Sampatha and well-being things, gymnasiums, and finance. They're doing some financial assistance for their staff, and also they're giving good, safe working environment to their employees. Now we are moving to the social responsibilities. Uh, CDB doing more or less lending facilities to the rural economy to develop rural economic. And for example, they net lend last financial they lent 15 billion to the to develop rural economy, and also they're taking care of Sri Lankan children's education, health, and literacy. Also, they empower youth, women, and entrepreneurs for things like CDB SME Friday, SMB Friday for the entrepreneurs, and 27% of their net portfolio represented by the women. Now we are moving to the environment. For CDP, they're doing responsible financing, and for they won ISO carbon verified certificate for fourth consecutive year, and also they doing CDB introduced they introduced CDB INET, CDB transfer, and CDB deposit, things that can reduce the paper wastage and fuel consumption of both company and the customers. And also they're doing a lot of eco-friendly lending such as hybrid and electrical vehicles. Finally, we talk about environment integration. From 2015 to 2018, their branch network is improved, but they managed to keep their electricity consumption and water consumption in same level. Those are the what we done for the CDB finance. And let me summarize what we talk about till this. We do analytical framework for CDB finance with comparing Apico finance, market analysis, and alliance finance. Basically, we talk about two main type of analysis, that is financial analysis and non-financial analysis. So thank you very much for listening us.